Hey traders, Raghee here, and in this recap video for Simpler Futures, we're going to cover heating oil. Now, heating oil had a very volatile day today. You can take a look at this candle, and this has been a fantastic winner for us. But I want to talk specifically about this candle because a lot of mistakes will be made there, could have been made there, and I'm going to show you how to avoid that while keeping in mind that, well, we do want to squeeze all we can out of a great trade. And this has been certainly a great trade for us. But on the flip side, there's a couple things that I like to remind myself. One is I want to get out while I can, not when I have to. That's one thing. The other thing is there's just no way traders are going to regularly catch the entirety of any move, meaning the whole lot, it's a fool's errand, and it's going to cost you money doing this. To say, I'm going to get that, and I'm going to get that. Nobody does that. Nobody does that. I take that back. People in demo mode do that. Demo traders, man, they do that all the time. But in the real world, where money is at stake, and trades are executed with not demo dollars, but actual ones, the fact of the matter is we've got to be okay with a little bit of, as they say, FOMO. Okay, that fear of missing out is exacerbated by a couple things. One, if you trade a single contract, you're going to be especially vulnerable to this because you're afraid that once you get out, obviously you can no longer profit from the prices moving in your direction. So you'll tend to keep a trade open for probably longer than you should, rather than saying, look, I've got one contract, I've hit my profit target, it's my job as a trader to pay myself, so I must. That level was up here. And, look, with one contract, you really have two choices. And really, it's only two. The first one is pay yourself. That's number one. The second is next time around, look at if there are any alternatives in minis where instead of a single contract, you could buy multiples of a smaller increment, a mini contract. The other is to have a fairly tight trailing stop. When I say fairly tight, what we want to do then is transition to an uptrend that is showing us, that is basically showing us the climb that we're seeing on the daily with healthy support at the wave. I think both the 15 and the 30 were very good, what I call trailing stop trades. Now, I know not everybody is going to fit into the same exact sort of psychology and wiring that, say, I am. But there are always going to be alternatives. So I'm always willing to give you alternatives because at the end of the day, it's less about making you a trader like me. I mean, in terms of what you see and why you do what you do, because let's face it, that's going to be hard enough. It's hard enough to be a trader. Trying to be a trader like somebody else, trying to be somebody else is darn near impossible. So the flexibility I give you, these are all valid trade management alternatives. The idea here is you find the one that best suits you in your situation, okay? So what I would ideally want you to do is when you hit a profit target, pay yourself, okay? That's it. Now, if I have a move higher that is reflected by a very healthy, wave-supported, green grab candle-dominated uptrend, I can use that as a guidance trade or a trailing stop trade, meaning as long as the intraday uptrend is intact, I can keep that trade open and just trail the stop until we break the 34 EMA on the low. In other words, the intraday trade that I'm relying on, in this case, a 30-minute, what I would call trend following swing buy, once this is no longer valid, neither is my trade. In other words, I'm going to put that stop in at that point. I can scale out. If I have one contract, I get flat. Now, I said you could do the 15 or the 30. The latitude is how much unrealized profit are you willing to risk? That's the difference. How much unrealized profit are you willing to risk? And this isn't just an internal question. It's how much unrealized profit are you willing or should you risk? Okay, so there's the willing to risk conversation and there's how much should you risk. The should you risk can come from an hourly price movement range or the expected price movement range. In other words, how much latitude does the market need? Not how much can you tolerate giving back. That is obviously part of it. But if you can merge the two somehow and take the subjectivity of how much you want to give back or willing to give back versus how much movement a 15 or 30 minute time frame needs, in terms of its typical ebb and flow, if you can basically merge those two with data like this, backing off by a certain expected price movement range or by the hourly, you've at that point taken what is a subjective need to see how much higher is higher while satisfying that FOMO, that fear of missing out, pig in the head, right? With some good objective trade management. And that's how I do it. And that's how we manage heating oil. Fantastic trade for us. A number of ways we could have managed it. This is really 2 of them. And again, you have to ask yourself, if you're unwilling to take the profit up here, you need to then shift gears and say, all right, pig in the head, I get it. You're wondering how high is high? I am too, perhaps. Go to the guidance trade. Go to the trailing stop trade, which is going to be a valid intraday trend follow. And as long as that's valid, you're in. When it's no longer valid, you're out. I'll see you in the next